All right. Good day, everyone. Good to have you here. Welcome to the Tatro Show. Pretty excited about our guest today. Bringing him in all the way in from, I think, his home. I think he's working from home today. I'll bring Martin Roberge in right away. Bienvenue. Welcome, Martin. So welcome to the show, Martin. Pretty excited today. Catching you maybe on holidays? No, you don't take holidays, do you?
No, well, I do, but in August only.
Okay. You are in Montreal, correct?
Well, South Shore. I'm in Candiac, which is about 20 minutes from Montreal.
Okay. For those of you that don't know, I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and the Tatro Wealth Advisor Group. I've introduced him, but I'll bring him again more formally. I'd like to introduce right now Martin Roberge. He's Managing Director, North American Portfolio Strategist here at Canaccord Genuity. He's got a CFA. He's been doing this for a while. He's been right on a lot of calls in the past since I've gotten to know Martin. Incredibly smart guy. If you're watching on YouTube, please click the red button to subscribe. Subscribe to our videos, subscribe to our channel. I believe it's the next one is on commodities. Do you want to chat briefly on this one?
Yeah, this is the relationship between, when you talked earlier, Rob, about liquidity, surge in liquidity, you can measure liquidity using various metrics. The one that I like is to look at the increase in monetary aggregates. This is like basically the money sitting in bank accounts, cash deposits, or in mutual fund money market assets. Okay, so if you sum all this cash ready to be spent, okay, together, and then you look at the relationship with the economy, the blue dotted line shows if there's too much cash versus the economy or too little cash. So the higher the blue dotted line, the higher the amount of cash relative to economic growth. And what you've seen, or what we've seen this year, as you mentioned earlier, like it's an exponential spike in liquidity and in monetary aggregates in the US. And historically, when you look at this gap between liquidity and growth has been very weak. So the spread is really high. And that means that economic growth is likely to improve because we've got liquidity to fuel it. But most importantly, for commodity investors, it means more commodity demand. More commodity demand means higher commodity prices. So the reason why I want to put that chart there is because commodities is an asset class, Rob. Okay, we tend to forget about it, but it's an asset class. You can buy ETFs that are replicating the performance of a commodity. Okay, you got to be careful on which ETF to buy, but certainly this is good from a commodity price of view that Canada should normally participate to this non-US rally owing to this surge to come in commodity prices. And the bar is very clear. The commodity, the super bull in commodities is likely to be a 2021 story, but the stocks will anticipate this 2021 a year in advance. Hence, some of the resurrection we've seen in base metal stocks, copper, for example, wouldn't rule out to see oil eventually participating energy equities as well. But this is just a reminder that if we've got a good commodity price environment in 2021, this is obviously a good thing for Canada because we are very resource centric. So when it comes to comparing Canada versus US, there's a tactical, and this is just a tactical cycle where Canada could at least match the performance of the US market.
So you mentioned a lot of things there. I think one of the key is, first of all, Canada is a commodity-based economy. If you didn't know that, welcome to the show. And there you go, free piece of news for you. A lot of commodities in Canada, lumber and the base metals and, oil, and aside from the ones that we know, even water and whatever it may be. But
gold as well.
Gold, yeah, for sure. Do you see, I look at some of these micro cap stocks and these micro cap sectors, the mining, some of the exploratory stuff. Do you think that those things could come back, Martin? I know, that's not supposed to be the topic of the day, but we've seen them down for so long.
Yeah, actually, if you look at in the U.S., they have the fangs. Okay, there is some kind of a bubble brewing in that segment of the market, and in Canada, we're not there yet, but we've got the TSX Venture. The TSX Venture is up year to date. Can you believe it? Okay, so it's a basket of small cap mining stocks, mostly gold. I would say probably half of the weight is gold and half is I would say industrial metals and lumbers and other commodities, and and I think it reflects the fact that these stocks have been like out of the radar screen of so many people for so long that now that you've got the gold price moving and now also copper moving, it seems like finally there could be some catch up to the larger cap companies, because if you look at most stocks trading in the small cap index or the venture index, like they trade at very depressed multiples, and it
Yeah,
seems like we're seeing just like at least a realignment with the valuations of larger cap equities.
they've been, as my dad would say, in the penalty box for way too long.
Yeah,
Nobody wants to give them any respect. They're going to stay there until they have to show. They typically will have to show earnings or show something. But it's really interesting. The TSX Venture, a lot of money's been made in the venture in the old days, and a lot of money's been lost in the last, I don't know how many years on the TSXV, and it's up 2020. Who would have thought? I believe you call that when we met in October, November. We had a meeting here in my office, and I vaguely recall you calling that exact scenario. I'll move on here on the topic of interest rates. I just want to remind you guys that was a 30-year chart that we showed. 30-year chart. When I got into the business, interest rates were at 5 or 6%. These bond yields, and everyone was saying hedge your portfolios against rising interest rates. They're going to go up. They're going to go up. Interest rates are going up. And then a year or two passed, another year passed. Now we're at 3 or 4%. You got to protect your portfolios, rising interest rates. They're going up. They're going to go up. And another year or two. And now here we are, zero rates. And we got to protect our portfolio against rising interest rates. It's been straight down here for a long time.